We have three companies that join us today. We've got Dan Cordova from London, Texas. We have Jim Heineman, John Clark from Bettendorf, Iowa. And we have a closely held insurance company here today. And I don't see Mark, but it is called Captive Alternatives. And we'll be talking today about metals in general, the economy, and what we're going to do with our money, and a little safer way to go with our money, and what we can do in a self-directed direction with our money, and giving ourselves more control. With that, I get to Daniel Cordova, owner of Asset Exchange Strategy. Daniel, thank you.
Well, thank you. My show was pretty good last time. We got a couple of people coming back. Yeah, it's a good thing. All right. Well, we have a little disclaimer here that everything that we talk about should not be construed as tax advice nor investment advice. That's all Jan's fault. So you all need to talk to him about that. Well, in all of our products, we were primarily a internet-based company since 2000. This is our first year that we're going out on the distribution channel through advisors. And one of the requirements is you have to have a license, and the insurance licenses are minimum, or you could have a securities license or a CPA or an attorney, as long as you have some sort of fiduciary responsibility towards your client. Okay. World Metals is the only IMO marketer that we use presently for the product. And so Jim can help you with our local person, or if you're from around, away from the area, we can help you there as well. Main Street is our company that we started in 2009, and the purpose for Main Street was to conglomerate assets that are non-traditional. So if you went to a traditional investment advisor, he or she would say, you need to buy these products, and then they would put it under a managed portfolio, and they would help you so you're not too heavy on one side, or not you're not in a particular asset too long, whatever your requirements are for your objectives. And so we took that same plan and we created a cocoon around non-traditional assets and provide that same service. Okay. The reason that we can do that is because the traditional securities firms, they can't get their arms around valuations. That's their biggest hiccup. Valuations, and then all of the tax reporting for the assets. They don't want to mess with it. Everything else, they can do all the other stuff that they have right now electronically. You sell something, automatically creates a 1099. No question asked, just done. Well, this is a bit more manual on how it's done. And so there's a bit more control, and it's actually easier if there is a mistake done to get it fixed. If you've ever tried to get a 1099 fix from a broker-dealer, it's almost impossible. They just won't do it. All right, and Asset Exchange Strategies has been in business since 2000, and we have been specializing in the IRA LLC and the self-directed 401k. And basically what that means is you have checkbook control of your retirement system. And so we've taken all of the information, all of the compliance that we've learned over the last 13 years. We've taken all the audits that we've been through, everything that we've experienced for the past 13 years, and we say, we know a lot about this stuff. Let's become the trustee for these products. Thank you, Vanna. All right. Well, what is it that clients are looking for? And I think if I were to ask around the room today, all three of you would say, I need yield, because you haven't got enough of that in the past 10 years. You've just had spurts here and there on those yields. And I'll let Jim talk about more of the specifics about why these things are happening as far as yields on the stock market and why we may not be seeing them in the future again. All right, so the stock market is at an all-time high, but there is a mass exodus from the bond market, and annuities are getting tougher to sell because of the ability to sell the low rates that they have. Metals are down 26%, and Wall Street is predicting $12.50 and $18 is watershed moment for metals. We're almost there, aren't we? So we're going to see a larger movement in that area, but again, Jim's going to cover that. But part of the question is, if you see this, where is it that you want to go? And we think grabbing onto these non-traditional assets is what you want to do today. Okay, so the wealthy, which all of you might be wealthy in here, but, and I think you'll agree with what's being purchased today, oil. That's something that people are going to need more and more of. That demographic is growing, consumers of oil. Silver and gold, that asset in the physical sense, unfortunately, is measured by paper assets. And so that goes up and down with paper assets. But there's a huge demand for metals, physical metals, by the sovereign countries. And then, of course, income-producing real estate notes. Warren Buffett put out a video, or was interviewed by a financial person, and he said, if I could buy 1,000 or more, maybe 50,000 of these little houses that we're going to talk about, I would do it. He just couldn't figure out how to manage the function. Otherwise, he would have bought all these products that we're going to tell you about. Okay, so the average portfolio is going to have 50% of these tangible assets encompassed within them. So let's take a little peek behind the curtain here, see what we have available for you. Okay, so why listen to us? First of all, Wall Street is a casino. I mean, you're up one day, you're down the next. You're up one day, you're down the next. You never really know what you can do. One of these days when I'm old and gray and if I'm only on Wall Street, when can I get out? I really don't know because it changes from day to day. Oh, I missed that window. I have to start again. And I can't figure out when my exit strategy is going to be. So if you're in your 60s or 70s or 80s and you're trying to get out, man, I think that causes a few heart palpitations in trying to do it. Okay? And you want control. You want to be able to establish a control over your assets. Very difficult to do. You can't go to GE and say, CEO, I think you're doing things a little bit wrong. Let's see if we can adjust a few of those management skill sets you have. All right, so we want to take and make that grade, and that's demand ownership of tangible assets for a better return. Let's beat inflation, and let's get some money, some cash flow back in the mailbox. We also want to be transparent on the assets that we're purchasing. Unlike some of the things that are on Wall Street, you can't really tell what's there. You're buying what you think is there, but you don't really know. Okay, so why should you listen to us? Little old town from Leander, Texas, a little company like ours. Well, first of all, go ahead. We know what we're doing. We've been doing this for 13 years. I think we are the premier advisory group when it comes to self-directed retirement accounts. This is no small number. We've moved $2 billion away from Main Street, from Wall Street to Main Street products. And we have 5,000 clients. So just do the math there, and you can see how much the average client has in their IRA with us.
To have 5,000 clients and not have one complaint is a very unusual position for anyone to be in today of the company.
Absolutely. If you put my name in Google, Daniel Cordova, you will not find a blemish. If you do that for our company, you will not find a blemish. For 13 years and dealing with 5,000 and some of these clients not being very nice, you're absolutely right. Okay, and of course we've been quoted in the financial press. I don't know if that really makes a difference or not, but they do look to us as expert advice. All right, so let's take a little bit of an understanding of what you've already gone through and what we go through is risk tolerance. Go ahead, Duke. We have this little book here. It's in your portfolio. It's the asset allocation guide. Just like your normal financial advisor would do, you would go through a series of questions. What's important to you? When is important to you? And how is it important to you? And we take those series of questions and we develop a structure as to what we should be able to buy for you, given what your goals and objectives are. Okay. So just take a little test here. Your time horizon, your financial goals, your risk tolerance, that gives you a total score. That gives us a number. That number gives us an allocation. In this particular case, because we're Main Street we use Main Street language. And so in this case, we have eggs in the basket. Well, how many eggs should you have in a particular basket? In this particular basket, the guy's a realist, and these are the types of products that they might put their eggs in. Go ahead. And in this case, this realist might put 25% of his money in non-recourse lending, 40% in real estate, might put 25% into structured settlements, and might put 10% into gold and silver. All right, again, since we're Main Street, we talk in Main Street terms. So what we try to do is we try to take these asset classes that we deal with, and we try to make a relationship to something you might know about. So for example, a CD. Most people understand CDs. A CD has a very bad return. Okay, so the returns are going to be bad. However, their liquidity is pretty good. All right, real estate, the returns are going to be very, very good. But the liquidity is not going to be as good as a CD. It takes a month or so to get rid of the property. All right, so let's take a look at this. We want to look at 45 to higher returns in real estate, 25% to trust deeds, and 30% in this case to pooled funds, and then again, precious metals. Go ahead. All right, so why should you own real estate? First of all, it's mailbox money. It comes to you every month. Second of all, in our program, if you wish, you can do it on your own, but if you wish, it can be a managed program. So you'll hardly ever hear about the toilets, anything that occurs to it.
So you mean someone could use their IRA account to roll some of these properties into it, and if they said, I want to, at any given moment, turn my income on, they could start receiving 12.5% of their money next month?
Absolutely. Absolutely. And in some cases, Jan...
12.5% is pretty good compared to what the bank is paying 0.5%.
That's right. And in some cases, that 12.5%, that first month is a little bit higher if we hit it just right on the tax revenue. So we might get $700 or $800 back to you because the previous guy paid too much in taxes. Okay. So that's possible. Another reason you want to buy real estate is because it's a tangible asset. It's something that you can do something to improve its value. So you can put some potted plants in the front. You can paint it. You can put a little Home Depot bling on it. And for the demographic that we're dealing with, it works really, really well. So real estate in particular is a very good market. And you might want to say, well, you know, I've heard about it. I've worked it. I own some. Why is this such a good market? Well, part of it is because the numbers you've been hearing on job growth lately have all been blue-collar workers. Very few of them have been skilled laborers. So bartenders, waitresses, construction trades, those sort of things that are blue-collar oriented type of products or people. Now, they are all living in these products that we are selling. So the average person is making $700 a week, and the rent on these properties is $700 a month. So it's a pretty good ratio. 25% of their income goes to the housing, right? It's not a huge amount. And it's also the fastest growing demographic in the country today. So there will not be enough housing for these people in the days to come.
And you said most of your renters are long-term?
Long-term, 2 years.
2 years minimum?
Mm-hmm. Another phenomena that is occurring is, remember the elections? Mitt Romney would say 47% of our people are on assistance. Well, Section 8 is a market that you may want to consider. That market is electronic money every month, right in your mailbox from the government. And if those people do not comply with the rules, then they're out of the program. So it's not the same as it used to be. It had kind of a tarnished reputation for a while, but I think it's a pretty good program now. Okay, so let's take a look at a couple of opportunities here. Okay, we want to find the right market. The markets that we're in, Southwest Illinois, St. Louis, Indianapolis, Birmingham, and then that corridor between Indianapolis and Birmingham. All of those areas have inventory in abundance. Their prices are very, very reasonable, and they have a high demand for renters. So it makes the perfect mix for what we're doing. We also look for places that have high marriage. We look for places that, if preferably we want to be around a college, we look for places that have low crime. We look for places that have a diversity of the economy. We take all of those factors together, and when we find those factors are all congruent and they're all in the positive, that's the place we want to invest. Birmingham, for example, is the next Austin, Texas. It's the social draw of the South. And it has University of Alabama, Birmingham, which is huge. For example, the New York Yankees pay that university $250 million a year for the exclusivity to only have their players treated there. That's pretty good, isn't it? So there's some interest and there's some work that goes into finding where we're going to buy these houses at. The other thing about Birmingham, as an example, it's a very much a hodgepodge of a mixed demographic within any particular area. So you may have, over here in this neighborhood, you may have $200,000, $300,000 homes that yuppies are buying. Well, there it's called gentrification. Okay. Now, 2 blocks away, you might have some Section 8. But eventually, this is going to grow into that Section 8 period. And you want to be on that receiving end of that equity. Okay. And so we're trying to position those. How do we do that? We'll take a particular area. We will buy strategically homes in those areas for you. And then we will start to build those areas up with home ownership. That brings the comp value up. And then that starts to build and starts to draw in the middle class into that area. Now we're building equity for you. Now, it's not what we tout, but that's one of the things that we do as benefit. All right, so we find the right markets. Go ahead. All right, we buy distressed homes. They're both distressed financially, meaning we might buy them from HUD, we might buy them from the bank, we might buy them from any other government agency, and some of them are distressed physically, and some of them are pretty distressed, roofs falling down or whatever. But we can turn those properties into properties that are habitable and desirable, which is most important. We have a conscience about who we deal with and how we serve that renting public. And so we want to make sure that they have a good place to live. So we take a little property that might look like this, all boarded up, needs some damage or has some damage inside, and we turn it into a nice little house by putting some shrubbery up front, cleaning it up inside, has all new carpet paint, walls, and Home Depot bling, as we call it. Go ahead. Go one more time. All right. We also have long-term tenants. These tenants are about 2 years. That's what we try to do, is 2 years. If it's Section 8, one of the things you ought to know about Section 8 is they go by number of bedrooms. And those number of bedrooms also have to have certain criteria for them. For example, they have to have a certain size window to be able to egress in case of a fire. So sometimes the basement doesn't work for that. But these are long-term tenants, and if you have a Section 8, it doesn't matter if your house is this big or if your house is 400 square feet. If you have 4 bedrooms, you can get about $850 a month for that thing. All right, go ahead. All right, well, the last ingredient, and this is maybe the most important ingredient, is great property managers. Again, understanding the demographic is so very important. Well, we'll say that Tootie has been in this demographic for a while, and she's needed something from the government or something from somebody, and so her instant reaction is to go into the offensive mode and to get what she needs, because she knows if she doesn't fight, she's not going to get it. Well, that's the instinctive mode. But our property managers are not just property managers, they're almost psychologists, because they understand how to deal with these folks, and they understand how to calm them down, and they understand how to build trust so that Tootie can say, okay, Rashad said he was going to do this, he's going to do it, I believe him, it'll be taken care of. And what that really does is it almost eliminates the walls being kicked in, the windows broken, all the damage that might be occurred when people aren't listening to other people. Simple, simple concepts that we take into play and make them work so that it's profitable for you. All right, so here's another example, little house here. We got a spigot here that means is bringing out cash flow. Here's another example of a little house. Could have been the house you lived in when you maybe 5 or 10 years old. All right, all of our suppliers are carefully selected in markets. We want to make sure that we're using the most reputable people that we can find. That doesn't mean that we have to pay a whole lot for them to keep those prices down for you, but we try to find the highest quality person that we can find. We're also finding higher returns on homes that are older and renovated. So many of these homes there's one particular community that we're working in, Cahokia. It just so happened that this particular community was built all at one time in the 1950s, right after the war. So they all look alike. They all have the plumbing in the same place. They all have the wiring in the same place. So from a maintenance perspective, it sure makes it easy to be able to maintain those properties. Okay, the rents are high. As I mentioned, they're going to be $800, $700, $600 for a 2-bedroom. But we buy them at a very reasonable price, and we bring those savings onto you. Okay, so let's take a look at a piece of property here. This particular guy is in Birmingham. Very, very typical craftsman-style home. Who knows what this guy looked like when we started with it. But here we've revamped the kitchen, and it's got new Formica, nice new floors. The bathrooms are all clean. So again, it's called what we call Home Depot Bling. Now this particular property was sold for $42,000. It was built in 1928, but the important thing is that the bones are really good on this property. It's 1,300 square feet. The cost for that is $32. You cannot build a property for $32 per square foot.
I built a lot of different buildings, and I couldn't go to Home Depot and buy the material if I did 100% of the work myself and build that house for $32.
No way. No way.
Including buying the property.
Right.
And looking at the water and everything.
I don't even think, Jen, you could build it for $32 if you went to the Habitat surplus store and bought the materials for that.
With the land and everything else,
Yeah.
the utilities would be expensive.
Absolutely. All right, so this one has 4 bedrooms, 1.5 baths. The rent's going to be $725, which is pretty typical for the Birmingham area. Rent's going to be $8,700, $1,000 in taxes. The insurance is going to be about $700 a month. Management fee, in this case, $870. Vacancy, we put in there as a factor. It probably is not going to happen, but we put it as a factor. Typically, we try to keep our maintenance down to less than 4% per year. Okay, this is a year. That's a year. Everything's a year there. Oh, did I say a month? I'm sorry. Okay, so you should make on this particular property $5,200. That's a net of 12.5%. Now, within our community of investors, some people don't want to be homeowners, or landlords, and so they're willing to loan money. Now, they'll loan you money at 50% down, in this case, $21,000. It'll be 8% to you, so your adjusted net income will be $3,500, but your cash on cash is much higher. It'll be almost 17%. Where can you get 17% today? Day in and day out. How many years does it take to pay back your entire investment at 17%?
Well, your money doubles every 5 years.
Just under 6 years, right? Go ahead, Tim. Oh, one more thing. We also provide a 1-year home warranty that will take care of all the mechanicals, we'll take care of all the appliances on there. So it's on us. We'll get them fixed. We also provide for vacant homes a warranty. If your inspector comes in after a month after purchase and there's a structure, a code, or a safety issue that's found and we can't repair it, we'll give you a new house. All right? But it can't be an observable item. It has to be something that's actually there. All right. So some people would rather just finance the real estate. What we do for the financing real estate, we pay you, the lender, 9.5%. Our company will pay 1.5%, so we can discount that loan to 8%, so that the community can borrow it at 8%. Everything that we do, we try to do in 5-year increments, because it's really difficult to see any further than 5 years. So we try to establish that pattern: 5 years, 5 years, 5 years. Okay. Go ahead, Judy. Okay, so why would you want to be in private lending? Go ahead. It's a tangible titled ownership. Go ahead. It's 9.5% fixed rate of return, as I mentioned to you. It's going to be interest only, back to you in 5 years. It's going to be non-recourse financing. The reason it's non-recourse financing is because that way we can foreclose early or very quickly if you need to. And a lot of our product is sold with IRAs. And if they're sold with IRAs, we have to have non-recourse financing, as it's an IRS requirement. Okay? No one is on the hook personally. And they're just darn hard to find today with the rules of the banks as they are. Okay, go to it. Okay, so why not be the bank? Good. Buyers are in love with the property. It just astounds me that people still come to us and they're still in love with a particular piece of property they're buying. I don't know why they can't see it as just an investment, but they love the little petunias or whatever is on that property. So we'll be able to lend at half the price. It's secured on title with the county. It's secured certainly with home ownership, or insurance, I should say. Go ahead. And at 3 or 4 times the loan amount. And what does that mean? Is that we were talking about $32 a square foot. Well, we're going to insure it to be $90 because that's what it's going to cost to rebuild that thing if we have to. All right, here's a piece of property. This guy's in Indianapolis. And in this particular case, we're paying 9.5% for a loan at $19,000. Okay, at the end of the day, if somebody were to default, you would end up with 31% return on investment. You almost kind of want them to default. And guess what? I take care of the property for you at 31% return on investment. So if you want to keep the property, you can do that. All right, so it's our philosophy that we should take the golden goose that lays the golden eggs in your mailbox every month and buy some golden coins from Jim. And so you may want to take $400 a month, $200 a month, whatever that is. You might want to buy some precious metals with that. That helps you stay in that tangible asset. So this whole portfolio continues to rebuild itself every 5 years. Every 5 years, it's continued building equity. So why not have somebody manage this for you? Again, you could do this on your own, but I think it's better if it's managed because compliance failures. Of those 5,000 that we mentioned on there, a large number of those are incompliant. And it's because they didn't listen to us, they're off on their own, they're busy on vacation, you know, whatever the reason is, they're not in compliant mode. Go ahead, Judy. The correct tax reporting. Everybody or every IRA has to pay tax, or the tax is paid on the money before it gets to your IRA. So if you have a mutual fund, that mutual fund manager is paying the taxes on the gain before you get it in your IRA. Keeping your LLC compliant, because the LLC is our favorite entity to use with the state. You still got to do that. What to do with the cash that's accumulating, because we're getting these high volumes of cash coming in. We don't want to be overly balanced on one portion or other, so we want to rebalance every once in a while. Reinvest it, keep it growing. Keep going. We want to rebalance that account on an annual basis at least. And we want to keep our basket allocation as chosen. The penalties with the IRS start at 10%, and that's for the entire balance of that IRA. It's not just a portion of it, okay? So if you goof, the IRS does not, I don't even know, I don't think it's not they're empathetic. They don't understand. They speak a whole different language than we do. So when we try to help somebody, we have to hire somebody that can literally translate our English to their IRS talk. And we have the best chance of getting a reasonable response from them then. All right, so they don't care if it's an innocent mistake. And probably the most common one is they're allowing their son or their daughter to use the property. They're using the cash flow on a personal basis. They've gotten a credit card that they are personally guaranteeing for the IRA so they can do some rehab or something like that. Simple mistakes that cost them very, very dearly. Go ahead, dude. Keep going. Keep going. All that's considered to be is self-dealing. Go ahead. Keep going. All right, so what can you expect? Real estate, 9 to 14%. We were saying higher than that in the slides, but we say 9 to 14%. Notes, 7 to 9%, and then metals, something that 4 to 10%. Allocation, we don't know what that return is going to be, but the allocation is going to be somewhere in that 4, 10, maybe even 20%. Again, these values, just like any other asset, you could lose. Okay, here's what a particular account might look like. This particular person has 2 properties, and they have a note, and they also have a third party. So they have $126,000 that is invested. In the property, if they were to buy cash, they would get a return of 15.2. If they leveraged it, their return on investment would be 21.43 cash on cash. If they put it into a pooled fund, they would get an average return of 13.68. All right? So let's take that number of 126. That first year, it's going to grow to 143. At the end of 10 years, that number will be $412,000. That's without even reinvesting the cash. That's just the accumulation of the cash. All right, that's it. Are there any questions?
426,000 from 126?
Yep.
In 10 years?
10 years. And that's without reinvesting the cash, just the cash accumulation.
That's pretty rapid.
It's pretty rapid, yep.
In those 13 years,
10 years.
the return of 10 years being in business, the returns have been averaging, what you said, up there, 9 to 14%.
For our clients?
Yeah.
Well, because most of our clients have done it themselves, it runs across the board. But I would say that the average person, but what I could see, is probably around the 15 to 20%.
To clarify, his company starts the IRA account and gets the paperwork in all the nomenclature set up so that it's compliant with the government. You can go out and buy whatever you want and put it in. He's saying, buy it from them so they can manage it for you and give you a little bit of price. So that's the difference of do it yourself versus letting somebody help.
Yeah, the average person doesn't know all the rules. They don't know how to exit. It's a whole new game for them.
The IRS says your innocence of ignorance is no excuse.
All right.
And with that, we'd like to hear from Jim Heineman to talk about Royal Metals, why you should choose Royal Metals as the premier company to buy all your metals from, why you don't have to pay tax when you buy metals through Royal Metal, and the fact that they buy back on a guaranteed basis 100% of what they sell you at any time. But I can tell you this from writing many, many, many accounts with them, is they are Midwestern, Bedford, Iowa, good work ethic, extremely ethical, honest company, and have really stood behind my customers in the orders I place, both after tax and before tax. And most of my orders were used metal. And with the prices of metal currently, it certainly seems to be a top choice for a job, as says the news. But with that, Jim, please.
Well, good afternoon. I'm Jim Heineman with Royal Metals Group. I'm the Director of Sales. I don't think I really need this in the room. Can you guys hear me?
Jim? We do need it for the video, though.
Oh, we need it for the video. My apologies. Well, if we look at today's topics, you might wonder when you look down this, why am I covering these topics when I'm trying to talk about the why and the how for precious metals? I've been involved in sales and marketing virtually all my life. And it gave me great pause when someone tried to sell me something just to sell it to me. And I think it's important to cover the issues that matter most in making a determination on how to build your portfolio. And that's why, even though my total dedication is to precious metals, primarily gold, silver, and platinum, I talk about all the various aspects of the markets so that you, the clients, through your trusted advisor, can make an informed decision. I currently do webinars throughout the country, and I also now started doing a weekly radio show. And I found that if someone is just hammering a specific product, it just doesn't help people enough in making an informed decision. So I'll start off with the stock market. And I've been around the markets all my life. My father was a broker for 30 years, very successful. And so if you look at a history of the market since 1997, you can see the big upward move, the correction, pre-crisis, the move back up around '07. And then, of course, the big crisis, the financial crisis that impacted the stock market. And now, if you were smart enough to be in the market since May of 2009, if you were fortunate enough to get back in, you've enjoyed about 151% growth in the S&P, and that was as of last week. So this all looks very, very good. Oh, thank you. And let's look again at the stock market performance, because I think it makes a big difference on where people allocate and rebalance their investments going forward. If you look back at 1994, you've got two numbers. The gold line, very impressive. Now this is a bit dated because it only shows the Dow at 14,000. We know it's well above 15,000 now. But at this point, you had a nominal increase in value of 272%. That all looks really, really quite good. But we're told that we have no inflation. In fact, if you read, if you follow the financials, if you listen to the Federal Reserve, there's no inflation. I'm not sure what they're buying, but the government tells us there's no inflation. But if you take a look at this bottom line, this inflation adjusted line, your 272% nominal increase in value goes down to 141%. These are real numbers. And if you had individual stocks for a great deal of time, wow, look at McDonald's, 555%, but 325% return based on after adjusted for inflation. I'm not saying these are bad returns. I'm pointing out that there has been, and we all know there is, substantial inflation. This is a bit dated, but I left this up here for one reason. If you watch CNBC, if you watch a financial news organization, and they're touting stocks, they talk about the fundamentals. The fundamentals are good, they tell us. The stock market's doing well because of solid fundamentals. Well, when the chairman of the Federal Reserve in the same day can talk about continuing, or gives the impression he's going to continue the stimulus, and then yet that afternoon has a little bit of a different discussion, and the markets move violently in one day, those are not fundamentals. And what I'm going to show you is that the markets are heavily dependent on the quantitative easing. Go ahead. Now this comes from the Federal Reserve Board itself, and I was really pleased to find this because for the longest time we were told that the quantitative easing, that is the $85 billion a month that's created out of thin air by the Federal Reserve, wasn't really affecting the markets. The markets were going up primarily on their own good performances because of those so-called good fundamentals. Well, if you look at the dark green line, that's the S&P 500, and this goes from 2009 through 2012. The light green line shows the Federal Reserve credit. Look how they track. And in fact, you can see without a doubt when, like at this point, as it tracked up, look at the S&P. When they let off the gas on the stimulus, look at the drop with the S&P and then the corresponding increase. The correlation on this is 0.87. So not to be too long-winded, but the bottom line is their own data shows that what they're doing has a direct and huge impact on the valuation of the stock market. Go ahead. Now this is a video that I have. I'm not going to show it today, but this gentleman, Stephen King, not the Stephen King that many people might think of. Stephen King is the chief global economist for HSBC. He is considered to be the top-rated global economist in the world currently, so he's probably someone we should listen to. He has a brand new book out called When the Money Stops, The End of Western Affluence. I would urge you to get that book and read it. I'm in the process of getting it myself. But what Stephen King points out is that the markets, and you can go forward, are totally dependent on stimulus. Here were the following points that he made in this video. QE makes little difference to economic behavior. Now what he means by that is individual behavior. Because the whole idea of quantitative easing was it was supposed to greatly impact the individual behavior of citizens, of consumers. He said it really doesn't do that. Well, the reason it doesn't do it is because the money all flows into Wall Street, right? Not Main Street, like Dan talks about. He points out that the markets are dependent on QE. Most of the gains are a result thereof of QE. And then he pointed out, and this was over a month ago, that the valuations of equities are amazingly high while the performance of the economy is amazingly poor. And then finally he says that Western economies are hooked on what he calls economic painkillers. Now this comes back from May, but this is a very telling bit of data. And over the years, when investors have started relying on margin debt to buy stocks, when they become more and more attuned to leveraging, that's always been a precursor to a big drop in the market. And in fact, you can read that we've started to reach all-time highs in margin debt, even back in April and May. Please go forward. And here's what it looks like. And as an investor, I would take great notice in this. This is from the Wall Street Journal. And this is New York Stock Exchange fact data. To the left, you see the S&P 500 from 1993 on. And of course, you see, if you were an investor, you remember the great move up in the market up to 2000 with the corresponding significant drop. Then back up again, the roller coaster to 2007 with the big drop. And when you overlay margin debt, what's very telling is that as investors started betting on the market, meaning borrowing money to buy stocks, this has always been an indication of when the market was poised to have a big drop or correction. And of course, the same thing happened in 07, in 08. And now guess what? We're back up here higher than ever. So all these things, history repeats itself, and there are experts far more knowledgeable than myself that believes that these are all bad signs for the stock market. Go ahead. QE, I won't spend a lot of time on this. Most people, you know well enough about what this is. Go ahead, Jan.
What's this going to do to the price of metals?
Well, I'm not going to tell you that it's going to have a direct rocket effect on the price of metals. What I am going to tell you is that more and more investors are looking very hard at where they're going to reallocate. I work with a lot of high net worth investors around the country. I've gotten to know some of your clients. And as Dan showed on his slides, they all share similar characteristics. They're all buying income-producing real estate. They like to buy gold and silver, physical metals, on the dips, like where we're at now. And they almost all tell me that they either own oil or they own energy-related investments. So what we do know now is that the central banks of the world are back as buyers. We know that. And I'll show you here shortly. The Chinese central bank, the Japanese central bank, the Middle Eastern countries, they all believe that we're at good values on metals. They're buyers. But when you look at the QE just briefly, it's $85 billion a month created out of thin air. It's hard to get your brain around that. That a government creates $85 billion a month completely out of thin air. You could add over 2 million jobs a month, about $1.2 million, about 1.2 million jobs a month, I believe, if you pencil that out, at $50,000 a year. Quite a bit more than the $195,000 they produced in June. But this $85 billion a month, $40 billion of it buys mortgage-backed securities. That's to prop up the housing market. And most people would say it's had somewhat of a positive effect. The other $45 billion a month, they're repurchasing treasuries, our own treasuries. Now, what are they doing with these so-called assets when they buy them? As I'll show you in a minute, they simply go on the Federal Reserve's balance sheet. It's almost, again, hard to imagine that this occurs, but that's what happens. Now, the $45 billion a month that purchases treasuries settles almost daily, and that money, it flows almost directly into the stock market, especially with these low rates for bonds. Go forward, please. I'm a big fan of Bill Gross. Bill Gross leads PIMCO along with Mohammed El-Arian, one of the smartest minds appreciated by most in the world, one of the top financial minds. And he and Mohammed El-Arian manage the world's largest bond fund. He does a monthly newsletter that I would urge you to take a look at. You simply can type in PIMCO, PIMCO.com or PIMCO.org. But you can find the PIMCO newsletter and go to his monthly newsletter, and I can tell you it's probably a better education than anything you can get in finance. And I couldn't resist this in his January issue, which I would urge you to go back and read, Money for Nothing, Writing Checks for Free. But go forward, please. Now, here's what I mentioned with the Federal Reserve. Here's what they're doing with all these so-called assets. There are no investors out there to buy up these debts, or I should say these assets. These mortgage-backed securities, you can see the portion of treasuries. They're now up to $3.5 trillion. They'll be well over $4 trillion by the beginning of next year. And this is all just sitting on their balance sheet. Now, we have seen the value of homes come back from the crisis, but not nearly back to where they were. And please go forward. We call Ben Bernake Helicopter Ben. He actually got that nickname just discussing a policy of Milton Friedman, and I'll show you that in a minute. But more importantly, the Federal Reserve is talking about dialing down the stimulus because things are getting so much better. The job market, the economy, we've got a lot of cheerleaders out there. The real reason that they're going to dial it down is they're doing what we call, monetarists call it pushing on a string. There's no positive effect anymore. In fact, a great many experts believe that the QE has lost much in positive value other than pumping up the stock market. Please go forward.
Approximately what percent of each dollar is backed in precious metals? I guess at one time a dollar was worth a dollar in gold. This money they're printing, how much would you say is?
It's minuscule because and I can answer it only on a global term. If you would take all the gold that exists in the world, all of it, it would come up to about $9 trillion. That's if we had everybody's gold and most of the gold that Napoleon had, that the Romans had, it all still exists. But it's only about $9 trillion. It would basically take care of Europe's debt. The major European countries, it would not even touch. It would just touch over half of ours. So from our own gold, I have to do the math. It's minuscule, the amount of gold that supposedly that we do have.
When was the dollar actually worth a dollar in gold?
Well, if we go way back in history, we know we came off the gold standard in 1971, but it wasn't a full gold standard.
Wasn't it 1913? I believe I saw a 1913 dollar paper, dollar gold was equivalent in the buying power of that dollar since 1913 is eroded 73%.
I should know that information, but I don't keep track of that as much as others.
I mean, anybody ever here go to Rayleigh's, the grocery store? I mean, it's a nice grocery store. They got good stuff. But boy, are they proud.
I mentioned Milton Friedman, but more importantly, let's look at what's really happened in this country. This is from the Pew Research Center, and between 2009 and 2011, the highest earning 7% of our population saw their net worth grow by 28%. If you're in that 7%, that's wonderful. The problem is, the backbone of our country, over 9 out of 10 Americans have lost their net worth, and in fact, 93% of Americans had a net worth drop by 4%. Now, I won't go into all of Ben's comments here, but Milton Friedman in 1948 likened a helicopter drop of money for combating deflation back then. But the reason I bring this up is when we talk about all this money that's created out of thin air and basically pushed through the Wall Street banks, what's really starting to be talked about is overt monetary finance. It would be highly inflationary. I don't know that we'll ever see it, but what they're basically saying is, if we're going to create all this money, let's get something for it. Let's just put the money in the Treasury, and kind of like the old WPA of the 30s, let's put people to work building roads and bridges and other infrastructure projects. You'll probably never see that, but in my final point on this, and I mentioned this earlier to Brian, earlier today, if you look at from the financial crisis to now, we went in debt $7 trillion additional dollars. And I asked, on my last radio show, I simply put the question out to the audience, what did we get for that? Did we get a lot of new roads? Did we fix our roads? Did we fix our bridges? Did we build new ports, pipelines? Did we increase our industrial might? Did we grow our military? No, our military's smaller. We got virtually nothing for $7 trillion in debt, of additional debt. And in fact, what did we get? One thing is we doubled the number of people on food stamps from 20-some million to almost 48 million people. And we have the lowest workforce participation rate, about 63.3%. Since the Second World War. It's amazing how we've unwound the fundamentals of this country. Please go forward. I'm not going to talk a lot about Japan, but Japan now sees the panacea for their horrible situation as doing what we did, and that is flooding their markets with money. It's already showing that it's not going to work, although they've made their yen much cheaper to the dollar. And I won't spend a lot of time on the Japanese economy. And I'm going to move forward from this. Now, I mentioned Bill Gross, and I certainly admire him for his track record. And Bill Gross looks like he correctly called the end of the bull market in bonds. And in fact, on April 29th, as you'll see here, he said, folks, it's over. And historically, bond markets, it's almost eerie. They've run in 30-year cycles, very consistent. You can go back many, many years, almost 2 centuries, and bond markets have run in 30-year cycles. And Bill Gross simply says it's over. We've ridden the wave down for a great many years with rates. And it looks like he's right because now we're at, about 2.8% on the 10-year. Most experts believe our rates are going to go considerably higher over time. And when you say considerably higher, historically, the 10-year has been in the 5 to 5.5% range, right? So that sounds like a lot. and it is compared to where we're at. But again, you have a quandary for people in fixed income, because if you lock yourself into these low rates, you can get whipsawed by the bond market as these rates go up. So again, it's back. The reason I talk about these things is, okay, I've got money in the stock market, I've got money in fixed income, and I'm looking at tangible assets. What do I do at this point? And that's where I tell people, talk to people like Jan, your trusted financial advisor, to see where do I want to reallocate and rebalance, because these rates are eventually going to go up. And that's not my expertise. Those are the people like Bill Gross.
Tell them a little bit about world metals and why they should buy gold and world metals.
Give me one moment, I'll get right to that. Please. Go ahead and skip this one, please. Well, Bill Gross's, I shouldn't say sidekick, but his co-CEO, very well respected, Mohammed El-Arian, stated even 6 weeks ago that they had determined that it was not time to run away from the market, but it was time to walk away. So again, I'd just like to share expertise with you on various investment categories, and you can go forward. There are a couple of reasons, there are a handful of real simple reasons why you should consider owning physical gold in your portfolio, and also silver. But when you think about inflation, which in a minute I'll show you what that looks like. Of course, the government tells us we don't have it, but also dollar devaluation, which went to your point earlier. You can type in federalreserve.gov, and you can find the Federal Reserve Index. It's published every day. And if you look at the index, the dollar has lost 23% of its value since early 2008. So not only is inflation eating one side of your portfolio, the dollar devaluation is eating the other side. And please go forward. And here's what it looks like on a chart. In January of 2002, if you had income of $1,000, that $1,000 had the buying power of $1,100 and almost $20. By the time you got to January of 2007, that $1,000 only had the buying power of less than $948. And now you go all the way to March of 2011, and that $1,000 has the equivalent value of $826. It's dramatic, folks. Now, it's dropped lower than that. It came back up with what Japan's doing. The dollar index measures the value of the US dollar to the 6 other major currencies. The drop is even worse versus the Chinese currency. So you think of all the things we get from China and how your dollar is buying less. And so again, today, it's about where it was in March of 11. It's about 82 cents on the dollar. Here's what gold does in the face of inflation. Now, this chart came from Bloomberg and the Bureau of Labor Statistics. And this is interesting because between 1972 and 2009, we had 9 years in which we had what was considered high inflation. Now, not Argentina or Venezuela inflation, not that high, but high inflation in this country is defined as only a CPI, Consumer Price Index, of 5% or greater. In those 9 years, gold averaged a 19.2% increase in value. So again, we believe in a balanced approach, a conservative approach, but for the right investors, which many folks are, a 10 to 15% position in physical precious metals as a protection against dollar devaluation, which is very real and only going lower, and current and the coming inflation. And many people believe that we're building up a tinderbox with all this debt that's going to release inflation that's much higher than it is today. No need to talk about the debt. It's everywhere. We see it. We're basically at depending on which index you look at, 16 to 17 trillion dollars. These are actually a little dated because the numbers are higher.
The student loan debt is simply a huge number. I understand that that's the next debacle to unwind.
It's now, I believe I reached $1 trillion. There's a heavy percentage of those debts that are not being kept up with and not being serviced. And there's even been a discussion of some programs to wipe that debt out for a large number of students. My 3 children, I'm totally in favor of that. But we can go forward. This was a recent article in the Wall Street Journal, Central Banks and the Borrowing Addiction. And I had to use their graphics here. But please go forward one. Now this scares me tremendously as a father of 3 children that I want to see enjoy what I've enjoyed. These are the facts from this June 20th article. From 1950 to 1980, our economy soared by 191% in GDP in inflation-adjusted terms. Those were the good old days, remember? The 50s to the 80s. If you fast forward from 1980 to 2010, the GDP grew at a much lower rate of only 124%. But I missed one point. In this time of incredible growth and prosperity, if you combined the household, corporate, and government debt together, we only borrowed 12%. Now in this portion, we grew at 124% between 1980 and 2010, but we borrowed 125. And what this article points out is we've essentially borrowed our growth for those 30 years. And the author points out that there's no painful recovery from this type of action. Please go forward.
What was the mindset from 50 to 80?
I'm sorry?
What was the mindset from 50 to 80 period? You don't borrow 12%.
Well, again, I just think that we had fundamentals that we've lost track of. I mean, the mere thought that you could go into debt $7 trillion in 6 years, I don't know how we've ever gotten to this point. I think we certainly had different fundamentals socially, work ethic-wise. We certainly didn't have the unlimited entitlements. It was unthinkable that a grown man that could work would be on food stamps. I think it's just snowballed. And I don't pretend to have all the answers to that. But we've told ourselves that debt doesn't matter. And I'll get into some specifics further, but this is another chart from the Wall Street Journal. This was done by the Congressional Budget Office. These are the people we're supposed to believe. These are the people in the government that are supposed to be the most accurate and unbiased. And this scares me, and it should scare you for your future and the future of your investment portfolio. And the red line, the dotted red line, is simply our expenditures, all the way back from prior to 1980 to current. Well, actually, this is projected out to 2023. So here's our expenditures, and guess what? The dotted blue line is our revenue. Anyone with basic math skills can see that's a problem. And then you see the actual red line and blue line over the years, and they only crossed once in 2000, just after. And of course, we thought that we were going to have a bonanza of money to spend. That proved to be a mirage. But what I'd like you to take a look at is where we're at currently. Here's our actual expenditure line as it goes from actual to projected. There's where we're at today. And here's where we're at on revenues. That bottom revenue line is particularly troubling because we just had a massive tax increase, didn't we? And yet, look at that blue line. It hasn't moved all that much upward. Here's where I'm scratching my head wondering about the Congressional Budget Office, because they're saying that with Obamacare and an aging population and all the other challenges we have, that we're going to have a big drop in outlays. I'm not sure I'm buying that. And
A big drop in outlay, you mean for
government expenses, government expenditures.
you're taking all those, how can that be true? With
Again.
all those people that are currently uninsured, the reason they're not insured is that they're ill and health and could not qualify for insurance, and now we're adding all those folks. That's going to lower.
They're projecting incredible reduction in expenditures. This chart is amazing to me. They're also projecting incredible increases in revenue. So I don't believe these lines, but guess what? They still never touch, do they? Never, for the next 10 years, the Congressional Budget Office is saying, we're never going to balance the budget. It's not going to happen. But the deficit isn't as bad. So I liken it to, my doctor told me I'm 40 pounds overweight. The last 2 years I've gained 40 pounds. And he said, Jim, you got to lose it. That's 20 pounds a year that I've gained, right? So I guess I could go back to him in 2 years, and if I'm only 60 pounds overweight, I could say, look, the doctor's going to say, Jim, this is terrible. I'm going to say, no, you're looking at this all wrong. You're not using the government math, because I was overweight at the rate of 20 pounds a year, and now I've only gained 10 pounds a year in additional weight the last 2 years. I'm actually much healthier. That's government math, folks. I'm sorry I couldn't resist that one. But go forward, please. This just simply shows that the markets, the S&P, have been going up, 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 and the commodities have been going down or sideways. So again, when you think about reallocation, where do you want to invest your money? I'm not saying that you should make massive moves in whole categories, but does it make sense to take some money based on what I've shown you off the table in the paper markets and put them into tangible assets to the level that it makes sense? And many people would say, the central bank certainly, that it's time to buy metals. Please go forward. This also shows the value of gold, the ratio between the S&P 500 and the price of gold. And look how far down that ratio has come in gold's favor. So again, you could say market's way up, metals have corrected significantly. This was in the Wall Street Journal on Monday. Corporate profits lose steam. And basically, I would urge you to take a look at this. It's a great article. And it basically says that most of the Fortune 500 companies have cut huge numbers they've made massive cost cuts, much of that in full-time employees. So they've hit their bottom line numbers, but the outlook for the future is very questionable for this continued growth. So again, another third-party source on the market. And these were two additional comments about the market, basically the growth running out of growth steam, unless we get a massive pickup in business spending, and that we've had recently marked the fourth of the past 5 quarters in which sales in S&P 500 companies grew more slowly than the U.S. economy. So, two final charts. This is what silver looks like over 2 years. You might say, Jim, you're trying to promote precious metals. Why would you show this? I would show you this because if you bought into the stock market in April of 2009 or May of 2009, you've enjoyed a very nice increase. I think we're somewhere in the range now with metals. Silver in that $20 range, many people believe very strongly that this is where you want to accumulate additional precious metals, and I'll show one more chart like gold. The same thing. And this is where the central banks are saying, you know what, we really like gold at these levels. And I encourage people to be long-term investors with metals. It's important that you first have an adequate monthly income, right? Because precious metals don't pay that monthly check like Dan's investments do, and they don't pay interest. But for the right investors, this looks to be a very good time to accumulate metals. And I would say, look at buying from Royal Metals Group. We are a major precious metals dealer, and we work with one of the largest refiners and one of the top market makers in the world, one of the largest refiners in this country. We can access for you any and all of the silver and gold and platinum products that you might want. We deal mostly in the COMEX approved metals, which are everything that you purchase through Royal Metals Group is guaranteed to be genuine and pure. Excuse me, I'm losing my voice. But to be guaranteed to be genuine and pure. We do not report your purchases to the IRS or any government entities. We do not charge sales tax. That's not something we have to do. And through your trusted advisor, we'll help you, whether it be with your individual retirement account, self-directed or otherwise, or simply as an after-tax investment, we can help you determine what the best choice is, whether it be bullion, bars, or COMEX-approved coins. And with that, if you have any further questions, I'll kind of wind it up here. I hope I didn't go too far over.
Jim, that was absolutely excellent. Thank you so kindly. My last comment is that I've written dozens and dozens of accounts with Royal Metals, and they have gone over and above the top for the service of my clients, making me look good. And I can tell story after story about how they went through the extra mile, which they didn't have to do, but did to make me look good and make the client happy. And you know, we do come from the old school that the client is right, and let's satisfy their needs. So with that, I want to thank everybody for coming. I want to invite any of you to a concert I'm hosting this evening at the Goat House behind Valhalla Hall. Jonathan Smart, classical guitarist, is performing at 7:30, and we're going to be out there watching that concert tonight. Any and all of you would be welcome to be our guests.
Thank you.
Thank you. Excellent. Thanks for being